What if I told you that the wealthy aren't just making more money than you, they're also keeping way more of it? And it's not just because they're cheating the system, it's because they actually understand the system. Today, I'm going to show you how they do it so you can start playing that game to win too. Welcome to the Wealth Planning Podcast with Brister Law. My name's Anthony Brister. Today's episode is one that could change your entire financial future forever, because we're breaking down how the wealthy legally pay less than taxes and how you can too. You ever wonder why some people seem to keep more of what they make while others work just as hard or maybe even harder but get crushed by taxes? Well, it's not a coincidence. The wealthy don't just make more money, they know how to keep more of it too. And they do it legally by understanding and using the tax code to their advantage. In today's episode, I'm going to break down the strategies that the top 1% use so you can start applying them today. And stick around, because at the end, I'll share a real life client case study where we help someone cut their tax bill by 50%. So if you're a high income earner, a business owner, an investor, or just someone who's tired of giving away too much of your hard-earned money to the IRS, this episode is for you. Before we start, make sure that you hit the follow button so you don't miss out on more ways to build and protect your wealth. And if you have any questions about your specific situation, reach out. We're here to help. Let me tell you a quick story about two different entrepreneurs, and let's call them John and Sarah. We know Sarah's going to be smarter, right? John and Sarah both run successful businesses. They both make $500,000 in profit. They both made $500,000 last year. But here's a crazy part. John paid nearly $200,000 in taxes, while Sarah just paid $60,000. Same income, but Sarah kept over $140,000 more than John. And why? Well, because Sarah understood the tax code and she structured her income the right way. John, on the other hand, just used to hand over whatever his CPA told him in April to the IRS. Which one do you want to be? The best part is you don't have to be ultra rich to use these strategies. You just have to know the rules. One of the biggest mistakes I see business owners making is choosing the wrong type of entity. Most people just default to an LLC or a sole proprietorship, but that can be a massive mistake. Why? Well, because it can cost you thousands in unnecessary taxes. So let's break this down. Sole props, single member LLCs, or partnerships pay self-employment tax on every dollar of profit. That's an extra 15.3% tax hit if you're under around $165,000. Well, if you go to an S Corp or an S Corporation, this lets you split your income into a salary and distribution, and distributions aren't subject to the self-employment tax, so you can save that 15.3%. C Corps, I see people set up C Corps to try to get taxed at that corporate tax rate right now at 21%, but they're missing out because typically the only way you get the money out of there is through a salary, which you have to pay self-employment tax, or through a dividend, which you end up at double taxation. So C Corps really aren't great for small business owners. They do have a place, especially if you're planning to go public. You want to reinvest those profits into the business, but for most small business owners, again, the C Corp really isn't going to be great for you. So choosing the right entity can be the difference between paying $30,000 in taxes or $100,000 if you own a business and you haven't reviewed your entity structure in the last year or ever. You're probably leaving a lot of money on the table. If you want help choosing the right entity, just DM me on Instagram entity, and I'll send you a breakdown of which one might be the best for your situation. Leveraging the tax code really, really is simple if you understand kind of where to go, and that's where it's important to have someone on your team who does this. So here's the thing that most people don't realize is that the tax code isn't written to punish you. It's actually full of incentives. Think about it. Why does the government give tax breaks for real estate investors, for business owners, for people who invest in energy, agriculture, or research and development? It's because they want you to do those things. And the wealthy people don't just see taxes as something to pay. They see them as a game with rules, and they play those rules better than anyone else. Here are some examples. Owning real estate can unlock massive deductions. Think depreciation, accelerated depreciation through cost segregation studies, 1031 exchanges, different loopholes, hiring your kids or family members, being able to legally shift income to lower brackets if they're performing reasonable work for your business, setting up tax advantage retirement accounts that can either save money today through deductions or never be taxed again, like the Roth. The tax code rewards investors and business owners, so the key is really just think like one, right? Let's talk about some next level strategies that the wealthy use as well. The Augusta rule. You can rent out your home for up to 14 days a year, completely tax-free, whether that be to a stranger or your business. You can shift income, again, to family members, like I said, as long as they're performing reasonable work and you're paying them a reasonable amount for that work. Cost segregation studies for real estate. You can front load the depreciation and reduce your taxable income significantly if you qualify, right? A lot of people don't qualify and they get this cost seg and they're not getting the benefit too. So make sure to talk to your tax professional to see if that cost segregation study would actually do you any good. The best part, all of these strategies are 100% legal, but most people never hear about them or they never implement them in the right way. So let me share you a quick story about a client that we work with. He was a high income earner. He was a consultant making around $750 a year, and he was living in California. He was getting hammered with taxes. He was paying over $300,000 a year. So we did a comprehensive consult with him. He was in an LLC before, just a sole prop. We switched him to an S corp, saved him over $40,000 self-employment taxes. We set up a solo 401k, saved him another around $50,000 of that, and then we used real estate tax strategies and saved him around $60,000. By the time we were done, his tax bill was cut by $150,000, almost half. But here's a big takeaway. Again, you don't need to be ultra rich to pay less in taxes. You just need to know how the game is played. And if you don't want to figure it out on your own, that's why we're here. Go schedule a discovery call with my team at bristertaxlaw.com. See if we could help you if you're a good fit, and help you learn how to play that game. So if you got value from this episode at all, please follow, share this with someone who may need it. And if you're serious about keeping more of your money, DM me on Instagram, tax plan, and we'll take a look at your situation and see how we can help. And that's it for today's episode for the Wealth Planning Podcast with Brister Law. We'll see you next time.